So, here's the big question on everyone's mind. Is Dubai's absolutely red-hot property market a once-in-a-lifetime gold mine, or is it a ticking landmine just waiting to go off? It's a question that billionaires and regular investors alike are grappling with, and today we're going to dig in and find the answer.
This quote right here, it says it all. It perfectly captures the sheer ambition that's fueling Dubai's growth. They're not just trying to be a big deal in the Middle East, they're gunning for global domination. And that kind of ambition, well, it's a magnet for money and people from every corner of the planet.
And you know what? It's totally working. The world's super rich are flocking to Dubai. I mean, Mukesh Ambani dropped over $200 million on just 2 villas. Shahrukh Khan's got property there. They're all buying into this dream, and it's turning Dubai into a legitimate playground for the global elite. But what's the real draw? What's actually pulling them in?
Okay, let's talk numbers, because this is where it gets a little crazy. Let's say you invested 1 crore rupees about 10 years ago. In a city like Delhi, that would have grown to about 1.4 crores today. Not bad. In Mumbai, maybe 1.5 crores. But in Dubai, that same investment would have more than doubled to 2.5 crores. That is a massive, massive difference.
And look, this isn't just about Dubai beating its neighbors, its property market is outperforming major global powerhouses. We're talking an annual appreciation of up to 8%. That's faster than New York, faster than Mumbai. It's simple, really. Your money just grows faster here.
But listen, property value going up is only one piece of the puzzle. For a lot of investors, the real game changer is the rental income, the cash flow. A $1 million property in Dubai can pull in up to $85,000 a year in rent. That kind of cash flow potential just blows away what you could get in New York, London, or Mumbai. It's not even close. And then you get to this slide. This is the holy grail for investors. In most countries, you make a profit and the government immediately takes a huge chunk of it in taxes. But in Dubai, you pay zero, nothing on your rental income, zero on your capital gains when you sell, and zero property tax. You get to keep 100% of what you earn.
All right, I know what you're thinking. This all sounds absolutely incredible, maybe a little too incredible, right? So what's the catch? Every real estate agent is selling this dream, but they conveniently leave out the hidden dangers. It's time we look past that glossy sales pitch and talk about the potential landmines.
The number one fear in pretty much any real estate market is something called oversupply. It's simple, really. It's what happens when developers get a little too excited and just build, way more homes than there are people to buy them. When that happens, prices crash and investors can lose everything. You end up with ghost cities.
And don't think for a second this is just some academic theory. I mean, look at the crisis unfolding in China right now because of overbuilding. Or think back to the U.S. housing collapse in 2008. Well, the very next year, Dubai's market followed suit and crashed by over 50%. History has shown us very clearly that Dubai is not invincible.
So the big question is, could that 2009 crash happen all over again? Well, the data today tells a surprisingly different story. If you look at a metric called residents per unit, it shows that the population is actually growing faster than the housing supply. And the absorption rate is at 89%, meaning nearly 9 out of 10 new homes are getting snapped up quickly. That's stronger than New York or Mumbai. The demand today, it seems, is the real deal.
Okay, so people are buying, but is the demand sustainable? Can they actually afford it? To figure that out, we look at something called the price-to-income ratio, or PIR. It's a simple way to measure if we're in a bubble. It just tells you how many years of an average salary it would take to buy an average home.
And when you look at the numbers, it's pretty eye-opening. A ratio of 6.7 in Dubai is definitely not cheap, but then you compare it. London is over 19. Mumbai is over 30. So relatively speaking, Dubai's market is actually far more grounded in what its residents can realistically afford. Okay, now this is the part that blows most people's minds. In most major cities around the world, the rent you collect on an investment property, it won't be enough to cover your monthly mortgage payment. You have to pay out of your own pocket. But in Dubai, the rents are so high that they can often be more than your loan payment. Think about that. Your tenant could literally be paying off your property for you, and you might even have cash left over.
So it looks like the market's not a bubble, which is great news. But there's this myth that you have to be a billionaire, you have to buy a flashy penthouse to make money here. The actual data reveals a pretty surprising secret about where the best returns are hiding.
Let's break down the Dubai market, because it's not just one thing. You've got 5 main segments. Yeah, ultra-luxury is for status, for the flex, but it actually has the lowest rental yields.
For a savvy investor, the sweet spot is often in the mid-range and affordable housing. But get this, the highest yields, we're talking over 10%, are found in worker housing. It proves it's not about how much money you invest, but where you invest it.
But hold on. Even if you pick the perfect property in the perfect segment, there are these hidden traps. Landmines, really, that can turn the whole thing into an absolute nightmare. And most people don't see them coming. There are 3 big ones you absolutely have to know about. First, if you're a foreign investor, getting a loan is incredibly difficult. Second, Dubai's entire economy is tied at the hip to the US dollar, which creates a huge vulnerability. And third, that whole zero tax dream, well, it's not the full story, not even close.
Let's talk about that US economy link, because it is so important. Dubai's currency, the dirham, is pegged to the US dollar. That just means it moves in lockstep with it. And we saw exactly what happens back in 2008. When the US market sneezed, Dubai caught a serious cold. Its market collapsed. So if the US faces another big recession, history suggests Dubai is going to be extremely vulnerable.
And last but definitely not least, we have to talk about the zero tax myth. It's true that Dubai won't tax you, but your home country almost certainly will. Let's take an Indian investor, for example. Any rent you earn in Dubai has to be declared and is taxed back in India. If you sell the property for a profit, that's taxed in India too. This idea of zero tax is dangerously misleading if you don't account for your obligations back home.
Okay, so let's put it all on the table. The final verdict. The case for it being a gold mine? You've got strong population growth, incredible rental yields, and an active government. But the case for it being a landmine? It's vulnerable to a US recession, you've got hidden taxes, major financing hurdles, and a history of crashing hard.
So here's the bottom line. Is Dubai a gold mine? Yeah, it absolutely can be, but it's not a guaranteed win. Success there depends entirely on having a map to navigate around the landmines. And that means doing your homework, really understanding the risks, and having a crystal clear strategy before you even think about investing. So we'll leave you with this final thought. Now that you've seen the whole picture, the glittering promise and the very real hidden dangers, is investing in Dubai a risk that you are willing to take? The choice, of course, is yours.